and the one thing that makes them feel certain, okay, growing affection for the monetary metals. So I think once this next bull occurs, it's not likely to collapse. It's likely simply to become institutionalized. It's already becoming that way. We're close to that in certain countries in the world. And if this crisis hits as we think it will, it's going to be far more broad. Even the Western countries will suddenly have to rethink their notion of what's acceptable, what's a good norm. I love it when I listen to the financial networks, and my son, Brett, monitors all the stuff going on the internet, the advisors there and so forth. And everybody, when silver drops hard, that's when you get news stories about it. It's rarely that they cite the fact that it's been exploding for quite a while, especially this past month. But when it drops big, there's the headlines, and so that draws everybody's attention. And there's all kinds of stories that surround silver, that some of which are true and some not, but about, this institution is going to do this, or this exchange is going to do that, and that's going to wreck the whole market, etc. You got to be aware that what's underneath this beast, in our assessment, and so far we're right, is that it's going to a new reality. Silver's not going to have another $50 up move out of the range from 0 to 50 basically for 50 years and go up, and everybody's going to think around 100 naturally. That's a swing move, the dimension of the prior base. We think we're going to a new reality in the hundreds of dollars, and I think we're going to do it in about 6 months. Our clock started at the close of November. At that time, the price of silver was in the mid-50s. It was based on a signal we got from our relative performance analysis, spread chart analysis of silver versus gold versus the S&P, gold miners versus gold. All of these metrics said, we just shifted in a big way at a relative performance basis. When that occurred in 79, in the rush to the 1980 high, and in 2010 to the rush to the 2011 high, both big multiple gains in 6 months. That spread broke out, silver versus gold. We've had a situation since 2020, basically, of silver sort of underperforming gold. It's going up in price along with gold, but less so. And therefore, the spread relationship has been like a capped off. You broke through the cap at the November close. Now, and sure enough, if you use that as your metric, and it said, this is just the beginning of a massive shift of silver versus gold and also of net price, then the clock just began there. So it's not old, it's fresh. And our argument is, looking at lots of metrics, that silver is likely in the next 6 months to minimum reach a couple $100 and possibly more than that. In going to a new reality. Not this 50-year range has been confined, in which most actually commodity markets have not been confined in that sort of range. Copper hasn't, lead hasn't, but silver has. And it's saying no more, okay? And it's not going to do it in a slow staircase, corrective process manner. So what we've stressed to our subscribers for some time is that you've got to somewhat ignore the type of events that we just had yesterday, which, usually it takes a week or so and you get a 10 or 15% pullback, and then it takes you a couple months to go up and take out that high. Look back at October as a good example. We hit a high and we had a sharp break that lasted a couple weeks. Much of it occurred in the first week, but you couldn't get back to the high for about 3 or 4 weeks later. So you got whacked. But still, it was pretty fast recovery, given some of the other behavior of silver the last few years. This time, it was a 24-hour event. We went from a futures high at 82, dropped down almost to 70, and turned around today and hit 78. I mean, it didn't fool around. It didn't base. It didn't prove itself as support before it turned up. It just said, bam, back up, okay? In fact, we're back up trading now above the high close that occurred, high settlement price on Friday. So this is the kind of behavior that investors need to be aware of, that it is going to be part of this explosive advance, and just don't get upset by it. In fact, if you try to get out, the problem is getting back in, because sometimes it's not going to give you a nice base from which to buy from. It's just going to go whap right back up, and you'll say, what do I do now? So anybody who got out yesterday in the middle of that collapse, for example, is already behind if they buy back in. Don't get out. Now, in about 6 months, we'll be trying to define a place to then get out after silver has reached a new reality, because there will be major correction at some point. But I don't think you're going to see it until we get well into the second quarter.
Silver has spent decades trapped in a broad trading range, while other commodities broke free long ago. Copper, lead, and energy markets all transitioned into higher price realities over time. Silver did not, until now. Recent market signals suggest that long-standing constraints have finally broken. This is not a typical cyclical rally, but a regime change. Analytical indicators tracking silver's performance relative to gold and other assets point to a decisive shift that began late last year. History shows that when such shifts occur, markets don't climb slowly. They move rapidly, redefining what investors consider normal pricing.
Well, I mean, when the spread broke out last month, forget the net price of silver or gold. Quit looking at their charts, okay? But when that relative performance spread broke out, it broke through a multi-year high of where silver had continually gone to bump against the price of gold, where it created a ceiling of resistance that it couldn't perform better than that level. When it broke through last month, silver's up $22 on the month. 1 month. It's already been in a bull market. Why did it suddenly go up $22 in 1 month? The spread said the game has changed. And I think the game will continue for a couple quarters. And once it's over, we'll look back and say, oh, golly, wish I were there. Well, the way to stay there is to stay long until certain metrics that we're monitoring say, okay, now we've maybe reached the level and probably even overshot a reality level. So if silver is justified to be a couple $100 an ounce, like if you take M2, money supply, and go back to 1980 and factor in the money growth, the depreciation in the buying power of the US dollar, and then calculate where silver might be a couple $100 probably. There's no question about that. But if that's where it's going, it's likely to overshoot it, as most markets do. If they've made a big mistake, they often overshoot the correction of the mistake. And so be ready for that. And there's another thing going on with silver that people seem to be focused on silver itself, like the industrial supply-demand deficit that's been around for 5 years now. You know, why didn't it work 3 years ago? Well, suddenly it's starting to work. Okay, well, you don't have enough silver to meet demand, especially high-tech demand. Everybody's focused on those aspects of silver. And also they're all panicked by the potential that, oh my gosh, the COMEX will raise, the CME will raise the margin requirement. Well, they've been raising it all along. I think it was like a 13% jump on Friday, in fact, where they raised the margin rate. And in 1980, the chairman of the COMEX, who I knew, because he'd trained me as A.F. Hutton. I worked under him. He was the head of Hutton's commodity division in the mid-'70s. But he stayed the chairman of the COMEX till 1980, and he imposed no buying. Ceased buy orders. Silver's at $50 then. It had gone from about $3 to $50, okay? And the market crashed, okay? They think, oh, all they have to do is somebody on the outside, like an exchange here or there, can push a button and stop this bull market. They don't realize what's really underneath the surface here. It's not merely exchange margin rates that are causing silver to go up too much. It's that industrial supply aspect, but it's also primarily the monetary issue. Silver is money. It's been money for 3,000 plus years, along with gold. The poor man's gold, and also money recognized by various governments, including ours at one point. So That is what's going on, and there's bigger issues that are underlying that continue to drive, for example, gold. Is the issue of these dangers that exist and are about to implode and create even more central bank panic and printing. And that's the real driver under silver and gold.
Sharp drops and equally fast recoveries are hallmarks of powerful bull markets, not signs of weakness. Recent price action shows silver falling hard and rebounding within hours, not weeks. That behavior signals urgency and strong underlying demand. In earlier years, corrections often lingered, testing investor patience. Now the market barely pauses. This creates a psychological trap. Those who exit during sudden drops often struggle to re-enter as prices race higher. In fast-moving transitions, the real risk is not volatility itself, but missing the broader move while waiting for calm that may never arrive.
Yeah, the one area we're watching closely right now, and even the Fed is, because they said so, President Williams of the New York Fed a month or so ago gave a press conference or speech, and he said that the Fed is going to start, quote, buying bonds. And he didn't say he was going to do it to support that market. His excuse was to provide liquidity because it's been a fairly illiquid market, and they want to provide liquidity, like a little technical issue or something. Instead, the issue is the fact that on the long end of the U.S. government debt market, you've had no recovery, no drop in rates, no recovery in the price of the bonds for 3 years. T-bonds crashed in price between 2020 highs, around 190 price level on the 30-year bonds, down to 117 by October of 2022. And if you look at a T-bond price chart or a yield chart the other way, it's gone sideways for 3 years. In other words, there's no recovery in bond prices. They've been trying to base, there have been repeated rallies, three big rallies that we can measure, and they haven't been able to get off the ground. So where are T-bonds right now? In the 115s. They're still below the low of that crash low in 2022. That's how anemic they are, which means rates are staying high on the long end, which is choking to a lot of entities, corporations, commercial real estate, for example, that they need relief, not on the short end, but on the long end, and they're not getting it. And that T-bond market, technically to us, now looks like it's vulnerable for a downside in price, upside in yield. If you slip about a handful of points from where you are now, we're 115 plus, you get down around 111 on the T-bond futures. Right now, again, the T-bond March contract is trading 115 or so. That's not a big drop. But you drop that small amount, and I'm going to start to blow momentum structures that say, uh-oh, we're headed into another dive. The Fed can't stand that. The economy can't stand that. This is bigger than the stock market. So everybody in the stock market's all jubilant about this or that or AI or whatever. Oh, this sector's finally doing well. You know, they're not looking at the T-bonds. The Fed is. And the Fed's already spending money, printing money to keep that market from doing something that it's likely to do. And that's a factor underlying the monetary metals, because if you lose faith in government bonds, U.S., Japanese, UK, etc., they're all in trouble. Then the public says, what? What do I do? Where do I put my money that's, quote, safe? Because frankly, the stock market will follow that. If T-bonds start to break, the stock market's going to get gut kicked. And I think it will be. It's topping in our process anyway. Since January this year, the broad stock market is making a topping process. But those factors have yet to come into play. And when they do, what's that going to do to monetary metals? Massive fuel injection.
Much of the public discussion focuses on silver's industrial demand: solar panels, electronics, artificial intelligence, and advanced manufacturing. These factors matter, especially amid persistent supply deficits. But silver's deeper role is monetary. For thousands of years, silver functioned as money alongside gold. That legacy is becoming relevant again as confidence in fiat currencies and government debt erodes. Margin changes, exchange rules, and technical constraints cannot suppress a market driven by monetary revaluation. When trust weakens in paper systems, precious metals respond, not as commodities, but as alternative stores of value.
Well, let me put it this way. Let's talk about gold, the mama market right now. Since legalized in 1975, gold's had two major bull markets. One from the 1976 corrective low, just above 100. It rose to 850 in 3.5 years. That's an eightfold gain. Okay, 8 times the bare low. 2001, after lengthy pullback and then basing at a price of around $260, it finally bottomed and turned up and went to 1920, another eightfold move. Took it 10 years, different time span, but the same multiple gain. The conditions then weren't anywhere near like what we're talking about now, the fundamental underlying stability issues. Well, gold made its bare low in December 2015 at a price of $1,050. We're fourfold, only half as much gain on a multiple basis as were those two prior major bull markets. So, yeah, when you look at an arithmetic chart, it looks like, oh my gosh, it's been parabolic. No, it's only half as much strength as we exhibited between 76 and 80 and 2001, 2011. So if gold even just matches those multiples, it would be well over 8,000. That's just matching those. That's not exceeding. You know, I don't set that as a target. I'm just pointing that out. Frankly, I think if it ever got there, you go way beyond. And also, I think that the next outcome of this situation that has been unfolding and will suddenly now more rapidly unfold, so overstating that, you'll have fundamental factors that smack everybody in the face, like jeopardized government bond markets, central banks out of control, and you'll find gold and silver possibly being monetized. This country, that country, this country. And what will drive that is the pain that hits the public in these various countries about, and also their sense of uncertainty. And the one thing that makes them feel certain, okay, growing affection for the monetary metals. So I think once this next bull occurs, it's not likely to collapse. It's likely simply to become institutionalized. It's already becoming that way. We're close to that in certain countries in the world. And if this crisis hits as we think it will, it's going to be far more broad. Even the Western countries will suddenly have to rethink their notion of what's acceptable. You know, what's a good norm to proceed on? Is it still central banks playing their boom-bust game? Every other year or so, they inject money, the stock market goes up, then suddenly it busts, and they inject more money. You get the point. And so I think we'll have a rethink where instead of a quote, like you said, a bubble top, yeah, you'll have some sell-off, but I think you're going to likely be institutionalized at much higher levels. And a lot of that movement could occur this coming year.
While equity markets capture headlines, stress is building in global government bond markets. Long-term bonds have failed to recover despite repeated policy interventions. Central banks now openly discuss providing liquidity, a polite term for renewed money creation. Persistent weakness in bonds threatens pension systems, real estate, and corporate financing. If confidence in sovereign debt falters, investors will search urgently for stability. Historically, such moments redirect capital toward monetary metals. Gold typically leads, but silver often accelerates faster once momentum shifts, acting as both a monetary asset and a leveraged expression of systemic stress.
With other markets, yeah. Copper was in a range from the 1970s, 80s, 90s into about 2005, basically $1.50 to 50 cents a pound. Up and down, just like silver, $50 to $5, $50 to $5, for 50 years. Well, copper was in one for multiple decades. And in late 2005, it emerged above the top of that price range. Now, no doubt momentum factors would have told you ahead of time that's going to happen, just like it did with silver, for example. But then price broke out of the range. But what happened is it went to a new reality that was quadruple the average price of that prior reality, which let's call it $1.50 to 50 cents for decades. And suddenly it went into a range that had highs at $4.50 to $3, and you could draw a sideways line since about 2006. Of course, copper's living in this zone of price that if you took the average of that price zone versus the average of the old price range, it's like a quadruple. And that occurred in a matter of a couple quarters. The movement from one to the other, and then you're in a new reality. The same thing happened at a different time totally, so not coincident with copper, with lead. Lead had been in a multi-decade range, broke out, and it quadrupled in a matter of a couple quarters and lived in a new reality. Now, there's arguments, and they're no doubt valid, that silver's been restrained. Well, to the extent it's been restrained, then an error has occurred, a pricing error. And when a market makes an error and compensates for it, whether it's an excessive upside or excessive downside, quite often the compensation for the error overshoots the new, more valid reality that it should have been in. So if silver should be in a $200 to $300 range, maybe it goes to $500 first, overshoots it, because excess begets excess. And so I think what we're going to see is something along that line. And I think silver has even more arguments than copper or lead did. We know what they are, and it's not just the industrial aspect of silver, it's the monetary underlying massive wave that it's riding.
History shows that when markets correct long-term pricing errors, they often overshoot. Copper and lead didn't just adjust, they rapidly multiplied and settled into higher price zones. Silver appears poised for a similar transformation, with even stronger arguments behind it. Persistent supply shortages, rising technological demand, and monetary instability are converging. If silver's fair value lies far above past norms, the path there is unlikely to be smooth or gradual. Instead, the market may surge into a new reality quickly, reshaping expectations and permanently altering silver's role in the global financial landscape.